Welcome to the Explainer. Today, we're popping the hood on the Edelweiss Nifty REITs and Realty Index Fund. We're going to deconstruct the scheme information document to figure out exactly how this engine runs, the strict rules it plays by, and most importantly, what it actually means for your capital if you decide to jump in. Right out of the gate, take a look at this. The official riskometer is pinned all the way to the right, deep in the red zone. Very high risk. So the stakes are set immediately. As an open-ended scheme tracking a specific sectoral index, there is absolutely no safety net here against market downturns. And let's be real, real estate and REIT investments inherently carry some serious volatility. Here is our roadmap for today. First, structure and entry barriers. Second, mandate and execution. Third, the filtering framework. And finally, tracking errors and risks. Let's get to it. Starting off with Section 1, Structure and Entry Barriers. Let's deconstruct the basics. Now, you've probably seen this 10 rupee figure floating around for the new fund offer, or NFO. Listen, it is super important to understand that this starting price is just a structural mathematical mechanic for issuing initial units during the subscription window. It is not, and I repeat, not some magical indicator that the fund is fundamentally undervalued or cheap compared to its peers. $10 is literally just the starting line. What actually matters is how the underlying assets perform from day one. But here is where it gets really accessible. While the initial NAV is set at 10 rupees, your actual financial barrier to entry is incredibly low. Whether you're dropping a fresh lump sum or setting up an ongoing SIP, the minimum application is just 100 rupees, and in multiples of 1 rupee after that. That's a real game changer. It means practically anyone can allocate a tiny slice of their portfolio to this highly concentrated real estate theme without breaking the bank. Moving right along to Section 2, Mandate and Execution. Let's look at the actual blueprint. So the absolutely crucial thing to grasp here is that this is a purely passive vehicle. Its sole mandate is to track the Nifty REITs and Realty Total Return Index. Unlike an active fund where a manager is out there trying to outsmart the market, this thing runs entirely on autopilot. It blindly replicates the index constituents in their exact proportions. No selective stock picking based on company merit, and, this is key, no taking defensive cash positions if the market suddenly crashes. If the real estate sector takes a dive, well, this fund rides it all the way down with it. You can see that rigid passive mandate right here in the asset allocation. A massive 95 to 100% of your capital is strictly locked into the index securities. That leaves a razor-thin margin, a max of just 5%, allowed in debt and money market instruments like treasury bills. And let's be clear, that tiny 5% bucket isn't there for the manager to strategically time the market. It's strictly there to handle daily liquidity and process investor redemptions. All right, Section 3, the filtering framework. Let's break down the rules of the index itself. Think of the index as a highly concentrated funnel. It caps out at a strict maximum of just 15 securities. Honestly, just think about that for a second. Your entire investment in this fund rests on a tiny handful of publicly listed REITs and realty stocks. To keep it true to its name, a minimum of 60% of the total portfolio weight has to be in actual REITs. Plus, no single stock can exceed a 15% weight, which stops one giant player from taking over the whole fund. Oh, and here's a really neat trick. It specifically filters out the top 10% of the most volatile stocks in the eligible universe to try and smooth out your ride just a little bit. Now, to keep all those strict ratios in check as market values fluctuate, the index goes through a highly mechanical reconstitution every single quarter: March, June, September, and December. It looks back at a 6-month average of free float market caps. The eligible REITs are compulsorily included first. If they can't find 15 of them, the system just fills the gap with the largest eligible equity stocks from the realty sector, replacing the smallest ones to maintain that hard 15 security limit. It is completely cold, calculated algorithmic rebalancing. Finally, Section 4, Tracking Errors and Risks. Let's talk about navigating real-world friction. Because this is a living, breathing fund and not just a theoretical spreadsheet, you are going to experience what we call tracking error. Basically, your actual returns won't perfectly match the index. Why? Well, for one, the fund has to hold back some uninvested cash for those daily redemptions we talked about, so not all your money is actually working in the market. Then you've got market illiquidity causing delays when trying to buy or sell these underlying properties, trades executing at different times than the official index closing prices, and of course, standard transaction and custody fees. All of that creates a natural drag on performance. There's also a very specific risk regarding cash drag right at the beginning during the fund launch. The asset management company has exactly 30 business days from allotment to fully deploy your NFO money into the market. If they fail to do so, maybe because the market is just too illiquid, they actually have to report it. But here's the kicker. If they are still non-compliant by day 60, regulations dictate they cannot charge you an exit load if you decide to just take your money and walk away. It's a pretty solid built-in protection against prolonged cash drag. So let's wrap this all up. When you look at the massive concentration in just 15 securities, the total autopilot execution, and the inevitable friction of those tracking errors, you really have to ask yourself a critical question. Does a 15-stock realty index actually fix a structural hole in your personal portfolio, or are you just chasing a novel theme that probably already overlaps with your broader index funds? It's a specialized tool for sure, but even a powerful tool can cause damage if you use it on the wrong job. Thanks for hanging out with me for this explainer, and I hope this deep dive helps you make a much more informed decision.